All right, we're hopefully live. Welcome to another monthly live Q&A with Wealthion's Endorsed Financial Advisors. I am joined by lead partners from New Harbor Financial, John Lodra and Mike Preston, portfolio manager from Real Investment Advice, Lance Roberts, and Jonathan Wellham, CEO of Rocklink Financial. These are the folks that you see on this channel with me week after week. Jonathan, relatively new addition. And again, Jonathan, very happy to have you and your team join the stable here. We've had a lot of great feedback from folks in Canada who are very happy to now have a financial advisor in Canada that is like-minded and contributing to this series. So thanks all for joining me today, guys. We got a lot of ground to cover, not a ton of time to do it in. So we'll just kind of jump right in. Folks watching, if you're watching live, you've got the opportunity to ask questions here. Use the live chat to do that. I'll be monitoring that throughout the conversation and trying to pull in as many questions as I'm able to. I do have a starting list here from folks that got to jump on asking questions over Twitter. So we'll start with a few of those. If you're watching this recorded, welcome. And folks, if you're watching live and can't watch for the whole time, don't worry. This is going to turn into a recording right afterwards, so you can rewatch it at your leisure. All right, well, gentlemen, let's get started here. The main focus of, or the main theme of this discussion is what's in store for the second half of 2023. I would say the first half had a few surprises for us. As we move into the second half of the year here, what kind of second half of the year are you guys currently positioning for right now? Your guys' game is a game of probabilities. So what do you think is most likely, and how is that impacting your portfolio strategy from here? New Harbor, why don't we start with you? John, we'll start with you.
Yeah, thank you, Adam, and hello, everybody, and hello to the viewers here. Thank you for joining us. This really helps us to reach out to you and share our viewpoints. To speak about our views on the second half of the year, we must pay attention to the first half of the year. We've talked about it. I think all of us in our own way have talked with you, Adam, and your viewers about the narrowness of the market year to date. And, that's basically been the story. What we have seen of late is some broadening of the market, and actually some sectors starting to pick up the weight, if you will, from, we've talked about the Magnificent Seven stocks, the NVIDIAs, the Facebooks, the Googles, the Apple. They have disproportionately driven markets this year. We're starting to see underneath the surface other sectors start to pick up the weight. For example, the industrial sector. We've added some exposure to the industrial sector in our client portfolios, just as one example. I do have one chart I'd like to share with you just to kind of put it in context here, if I could. And I'll see if I can pull this over here. Let's see here.
Great. And while you're pulling that up, I'll just note I'm seeing the contributions from folks on the side here. So thanks for chiming in, folks. We are seeing your comments. One of them here is from Gary, who's watching this from inside a semi-truck. It looks like he's a long-haul trucker. So Gary, thanks for listening. And I do hear a lot from folks who have jobs or long commutes or whatever I guess that's one of the things that's nice about these long Wealthion videos is they help the miles go by. John, all right, I see you've got your image up here. Let me just add it to the stream.
Right.
Can everybody see that?
So this is and hello, Gary. As a kid, I wanted to be a trucker, and I still have a soft spot in my heart for big rigs. So thank you for joining us here today from the road. So this is a chart showing year to date through yesterday, the performance of the broad sectors of the market. And what you see here is a bifurcation. This big gap here between, basically the sectors that have carried this market so far this year have been technology and communications. I will point out this communications sector ETF. Almost 50% of that is Facebook and Google. So again, we're back to these Mag 7 stocks, which have also been a disproportionate weighting of these. These stocks, by the way, earnings, by and large, NVIDIA maybe not included, have stagnated. They're single-digit year-over-year earnings growth type companies. No way should they be commanding the kind of multiples and appreciation that they've seen this year. The consumer discretionary sector has been very strong, but we've seen a dramatic, clouds form on the horizon with the consumer. declines in consumer credit. The pent-up savings from COVID stimulus is exhausting itself. So these three sectors have carried the market. You look, most sectors are flat to down on the year. I'll note the industrial sector here that we've just added some exposure to is up a decent bit, but very narrow market, and that's really what we see in the even though we have a broadly tremendously overvalued market, we're going to be looking for opportunities emerging in sectors that have not caught up in the fray here. Energy's starting to show some signs of resilience, but that's our theme for the year ahead. Still very defensive, but very careful selection of some sectors and areas that are going to hopefully start picking up some weight here.
All right, thanks, John. Great kickoff here. Lance, why don't we go to you next? How are you guys at RIA positioning right now?
Pretty much when you have momentum in a market, the momentum's going to carry. And right now the FOMO chase is on. So you have two sectors that are going to perform, or three sectors that are going to perform well in a disinflationary environment. This is the whole theme of FANG stocks weren't dead back in October of last year when we were writing about that. In a disinflationary environment, growth stocks are going to rule because those are long duration assets. So I wouldn't expect anything different through the end of the year. I'd expect this momentum to carry. In the cyclical sectors, I think you'll get a pullback of 3 to 5% somewhere along the way. And if you do, I'd be, adding, weight accordingly to cyclicals versus defensive. Our portfolios, kind of split right now between cyclical and defensive, but defensives are going to lag. They just don't have the earnings growth to keep up with where we are in the markets right now.
All right, Jonathan, I'm coming to you in a second, but I do want to ask Lance about the tech space here for a second, because you talked about earnings growth, and that's why people are piling into big tech right now, right? Because they think it can outgrow in an inflationary environment. Or disinflationary environment. Sorry, I'll get one of those words right eventually if I hit each one. Here is a chart of the tech sector, and the trailing EPS is basically flatlined.
Right,
here.
But that's trailing. That's not forward.
It's not forward, exactly. Yeah. So we're seeing massive.
Forward earnings expectations for tech sectors are expected to grow between 7 and 14%, as opposed to about 2% for most other sectors in the market. So markets are going to follow earnings estimates, not trailing.
Yep. So just to speak to this, though, so right now we're seeing PE expansion, basically explode higher in the space because of this anticipation of future earnings. What is going to be driving that? Is the expectation right now that it's all AI, or is there any other sort of credible reason to expect additional growth?
Yeah. I mean, you're seeing services sector turned up over the last services sector expansion. That's 80% of the economy. That's turned positive now. So, you're back in expansionary territory in ISM, and you've never had a recession historically with ISM in positive territory. So since it's 80% of the economy, that's where your earnings growth potentially comes from. Now, I'm not saying that's going to occur. What I'm telling you is that's what the markets are expecting.
That's what the market's expecting. Yeah.
And markets trade forward expectations. Now, when those forward expectations change, then you're going to get a differentiator in the markets, but that will probably not be until next year.
Okay. All right, great. And now, Jonathan, heading to you. How are you guys at Rocklink positioning right now, or what type of second half of the year are you guys positioning for?
Yeah, and it's a good question. I mean, going back to what John had mentioned, that part of that is just understanding where we've been the first part of the year. We still are very conservative, very careful. Interest rates, it certainly appears, are going to go up another once or twice. With that, I think we're going to start getting a peaking in interest rates as we get into the second half, and that should provide a little bit more opportunity to start to extend the duration if we're looking at some fixed income. We've been very, very exceptionally short, more money market. And so some of our clients who are just looking to get a little extra return will extend a little bit of the duration going forward into the second half of the year. Also, some of the infrastructure companies, we own a lot of our clients like to have pretty consistent dividend income. We've been careful about companies that are trading off of dividend yields because the interest rates have been going up. As interest rates start to settle, reach a higher point, and we don't, again, another 1 or 2 increases, then I think some of those companies that we like to own, we're going to continue to nibble and add away. Some of them have come off a fair bit, and some of them are trading inexpensively, largely because their cost of capital has gone up, and the leverage in the business has become more expensive with the increasing interest rates. And as has also been mentioned already with the other two individuals, trying to look for companies that are in the technology space, but not necessarily the big names, but going down further to find companies that can continue to grow quickly. Software kind of companies. We've owned Roper for many years, and looking for good free cash flow businesses that can redeploy back and continue to grow much faster than the economy. But we're expecting, though, that it's going to be a tougher slug in terms of just the economy. The interest rates are going to continue to pinch people. There's a lot of debt. And if it wasn't for all the fiscal stimulus, the big budget deficits that the governments are running, I think things would be a lot softer in terms of the economy. So up here in Canada, with the indebtedness of the average Canadian, it's even far worse than the Americans. And these interest rates are really starting to impact the housing market and areas within our economy. So we're being pretty careful there, and certainly staying away from banks, the Canadian banks, which have a tremendous amount of exposure to mortgage debt that is just outrageously high in Canada.
All right, and I do want to get to the housing market in a little bit, and specifically to talk with you, Jonathan, in Canada, because in many ways I think you guys are giving a preview to the U.S. of what the U.S. can expect, because you have such a greater percentage of your mortgages that are re-rating this year, because you generally have much shorter fixed mortgages than we do in the U.S. All right, so listening to you guys, and I don't want to put words in your mouth, but Lance, it certainly sounds like, listening to you, you think that the momentum that we've seen in the first half of the year is going to continue into the second half. TBD what the magnitude of that is, but probably you're seeing positive forward momentum carrying forward from here.
Right, but that's what history tells you. When the markets are up 10% in the first half of the year, historically they're up 10% in the second half of the year. So, it's just momentum. It's a momentum game. Once you start getting price momentum, once you start getting FOMO back in the markets, which you clearly have, once you get investors back on the bullish side of the camp, which has clearly happened, exposures are now pushing up into more extreme areas. Bullish sentiment is rapidly rising. That's going to carry for a while. It takes a bit of time to change that momentum. It just doesn't turn on a dime. And this is why every time the Fed talks about hiking rates, the markets go, yeah, we've heard that before, and then they keep going up. So, will these things eventually have an effect? Yeah, absolutely. But it won't be probably anytime this year. It'll probably be next year before we start seeing the impact and the lag effect catch up with the overall economy and markets.
Okay, and that's one thing I just want to dial through here is again, expectations. Lance, you seem to think momentum is going to continue. Jonathan, I heard you sort of say economy is going to struggle a bit more, but probably I got this general sense you think momentum is going to continue. You're still looking for additional growth companies that you might be able to safely put some money in. Correct me if that's wrong.
Yeah, absolutely. I mean, the reality is we're looking for the next 3 to 5 years. We're longer term business owners. We're more value investors, and there's always opportunities. And so, as Lance has pointed out, some of the other folks, it's been a very narrow market. And so we're not interested in chasing NVIDIA, but there's behind NVIDIA and below that, if you look hard enough, you're going to find companies that are still trading at good free cash flow yields and have great prospects going forward, even if the economy is tough slugging. And so we're trying to look through a tough slugging economy and find businesses that are very resilient, have a tremendous moat around them, and will just do just fine. But today are trading at very attractive prices, especially as we get close to a peaking of interest rates. I think the market is going to start looking forward and look for some of those opportunities. So, and a broadening of the market we would expect. It is very narrow, and so we have no interest in chasing just the fast performing stocks. That's not our game. We're not good at that, and we'd rather sort of say, okay, the next 3 to 5 years, what are some of the great businesses, and what are the companies that can grow at high single digits, low double digits consistently, and at high returns on invested capital.
Okay, and then Mike, just coming to you to close this out. I know you guys at New Harbor perhaps maybe a little more conservatively positioned, but from a momentum standpoint, do you expect, you're going to be playing in this market the second half of the year, or are you more nervous that we could see a change in momentum?
It's hard to say what exactly is going to happen in the second half. Nobody really knows, but it's true. There is momentum and the breadth is broadening a little bit. still very narrow. We spent a lot of time in our investment committee meetings doing our best to stay open-minded and scour the charts for good ideas. And the charts, and we do rely on the charts quite a bit when it comes down to picking sectors and individual ideas. We look at our broad indicators, and they've reversed up about a month or two ago in terms of telling us that the market was at least bullish in the short term. And so when we start to dig into sectors and we look at charts, and then we look at relative strength of certain sectors or all sectors against the S&P, and really it's been very difficult to find leaders. You look back at the chart that John shared, and there's not really much leading this market except for a handful of stocks. But industrials was one of those, and we decided to add that position. Biotech was another. We decided not to do that at this point. Gold itself is a leader, and the chart looks really good. So we'll see what happens if we continue to broaden out and more sectors start to break out. Absolutely, we will enter. Probably do it in a hedge fashion. We don't really believe in this market because of the macro factors, but that's what's difficult as a money manager. You have to do something, right? That's always the pressure or the belief. But I think a big value of what we bring to the table for our clients is that we have a system and emotional control. Now, we might get criticized if we go straight up into a blow off top here, because I don't think there's any way that we're going to participate in a big way. But we're trying to tactically add some exposure here and there when the ideas present themselves, but they haven't been that obvious, nor have they been that prevalent. So far it's industrials, and we'll keep looking for more opportunities.
Okay. Adam, let me just add a little subtext to that. So this all comes down to position sizing too. Against the backdrop of massively overvalued markets, no matter how you look at them, especially on those metrics that are timelessly indicative of future returns. It's a hell of a lot different to be at a Schiller PE of 10 versus above 30, approaching 40, depending on how you look at margin adjustments. At the end of the day, we work with real people that have retirements and financial security to worry about. Having 100% following a momentum trade is very reckless. And I'm not saying anybody here is advocating that, but it all comes down to position sizing and keeping in mind the big picture landscape here as relates to our clients' lives.
All right, great. And I'm looking forward to getting into some of the questions here from folks that are kind of, real world questions about, okay, how is this going to impact me as a regular person? Real quick though, just because we've talked a bit about how tech is still really just the big thing that's pulling this market along with it. Lance, I wanted to ask you a quick question about a chart that you just put in a recent article. Here's the chart, right, which is showing the dominance of these big 7 tech companies in the Nasdaq 100. And apparently the Nasdaq 100 is going to get rebalanced, I think in like a week or two.
No, on the 24th.
On July 24th. Okay, yeah. So can you just talk about that rebalancing, and if you expect that to impact pricing at all in the markets, as apparently these 7 stocks are going to get sold and that capital is going to move over to the other less loved part of the index?
The other 493. And so talking about the Nasdaq is going to rebalance, and they're going to take money out of those top 7 stocks. So if you're an index fund, there's nothing you can do about it right now, because you have to map to the index every single day. So on the 24th, they will rebalance those 7 stocks at the time that the Nasdaq 100 rebalances. So that'll occur. What you're seeing yesterday, you're seeing a little bit more today. You're seeing some selective rebalancing in those stocks already. Apple stock market's up today, but Apple, Microsoft are down. AMD's down here a little bit. But you're starting to see a little bit of pressure on those stock prices, just from the standpoint that other active managers are rebalancing ahead of that. It's not a deal. This isn't going to be the thing that triggers the market to a big decline, et cetera. The markets are aware of this. They know about this. And between today and the 24th, it'll all be priced into the market. Active managers will rebalance ahead of time. Index funds will rebalance on that day, and then we'll go on with life. But, it's everybody's wanting to make it a big deal. Remember the whole the spread between the 1 month and the 3 month was the determinant that everything was going to fail in the credit markets when the treasury had to rebalance, and it didn't happen. If the market knows about it, it's not a thing to worry about. And this is just the market working through that process. So yeah, don't worry about it.
Okay. We do talk a lot though about, the passive investing, algorithm the giant mindless robot that Bill Fleckenstein and Mike Green talk about. But by no means is this diminishing in any major way the impact of these top 7 stocks, but it does take a little bit off, right? It is tweaking those algorithms, right? So for every dollar that goes in, several cents now will not go into those top stocks as much, right?
Yeah, roughly 7 cents. So those the top 10 stocks make up 33% of the S&P 500. So now you're talking like the top 10 stocks will make up 30 cents of the S&P 500 when it rebalances, right? So it's going to basically shift some of that exposure to other areas, but it's not large enough to make a major impact.
Okay. All right. 2 other quick questions, and then we'll start really pulling hard from the live chat here. One, I had a really nice conversation this past weekend with your partner there, Lance Michael Leibowitz. But we talked a lot about the lag effect and whether it was still something that we really needed to keep in mind, or whether it was going to prove to be sort of the nothing burger that markets are currently pricing it at. I want to pull up this tweet from Sven Henrik just to set context here. He says, lag effects of rate hikes typically take a year to year and a half to filter through the economy. Remember, last time this year, I think this tweet's from May, but last time this year, the Fed funds rate was at less than 1%. Of course, we're now above 5% now. The hammer is still coming. So Jonathan, why don't we start with you? In concluding the conversation with Michael, he said, you got to respect the lag. How big of a factor do you think the lag effect is going to play in, if indeed we haven't seen the full expression of it yet? And when do you expect we're going to really begin to see the majority of that? Is that now more of a 2024 thing, or is that something we're going to be seeing increasingly through the second half of this year?
Yeah, I mean, we've been anticipating, a greater impact from the rapid rise in interest rates. I mean, the percentage change in interest rates has never been this large, largely because they were at record lows, of course. And so I guess I must say that we'd be a little bit surprised. We're a little bit surprised that we haven't had more impact in terms of the economy than we've already had. So I'm a firm believer that I want to be positioned. I'm not saying it's going to occur, but I want to be positioned conservatively, carefully, that if the lag effect does hit, and I think it will have a greater impact, then we want to be prepared with some cash, with short-term securities that we can deploy and take advantage of that dollar cost average, buy some of our favorite stocks, and also continue to find new stocks. In Canada, if you're looking at that lag effect, and we look at the real estate market, just not to jump into the real estate market, they're looking at about mid-2024 to latter part of 2024, and you're going to have a lot of Canadians over, maybe up to 50% of the market in the mortgage market having to refinance at double and triple the rates. And so this is, I think, definitely going to have an impact in Canada. In the US, also, I think that these rapid increase in interest rates are going to start to have a greater impact. So we're just being cautious, careful, well-positioned, making sure we're in companies that can weather that and also take advantage of the slower economy and this lag effect impacting. So I'm a believer that there will be more of an impact. There has to be the indebtedness, the level of debt to GDP, the level of debt to disposable income for people has never been higher, and these changes have never been larger. So we're cautious, we're careful, continue to incorporate that into our valuation metrics.
Okay, and just reading into what you're saying, it sounds like you're thinking, yes, it's going to be a real thing. It may still be a while before we begin to see it fully express. But it sounds like you're sort of expecting sort of like a rolling thunder, which of course the lag effect should be, given a year of continued raising interest rates, to be sort of playing out.
And as I say, we're surprised it hasn't had a larger impact. I think part of that, as best as I can looking at the economy, is that you still have a lot of money flooding in from the COVID days. and you've got a lot of government spending still at very elevated levels. But that too also has to slow at some point. I mean, these deficits are completely out of control, and the cost of financing the government now is gone up substantially. So these are all things that are certainly front and center in our thinking when it comes to investing and trying to protect people's capital.
Okay, John, let you guys from New Harbor give a quick chime in on this, and then we'll move to one last topic, and then we'll start pulling questions.
Yeah, so absolutely, we agree with this. This stuff takes time to work through. Whether it's corporate debt or mortgages or whatever, until on the margin, those borrowers need to face a refinancing or a pay down of debt. It's not an issue, and that comes over time. One thing I wanted to share, I referenced the consumer starting to look stretched in many ways. I'm just going to pull up one chart as an example. This kind of gets to the lag here. So again, I'm going to pull up a chart here. Let's see if we can find that. Okay, so hopefully you can see this, Adam, if you can put that up. This just shows, so May, we saw a pretty large miss in the expectations for month over month U.S. consumer credit outstanding. The expectation was for 20.3 billion month over month, came in at 7.24. So in February of 2022, that's when the rate increases really started in earnest. You've seen a steady, slow but steady decline in the month over month rate of consumer credit. So this is slowly moving through the system. But you look at charts of credit card debt and overlay where interest rates are. It just shows this kind of slow train wreck that is starting to run through the system, in our opinion. And we're certainly not in the camp that we think the Fed is going to pivot and start lowering rates anytime soon. That will only come, in our opinion, after some pretty severe wreckage.
Okay, that's a good segue into this question here from user Charger Mopar. Why wouldn't the Fed restart QE and lower interest rates to prevent the markets from collapsing, or as you're talking about credit beginning to slow and whatnot? There's no downside to them from financial repression, right? So Lance, why don't we go to you on this? I mean, I would think one quick answer to this would be, well, inflation. They don't want to rush to restart QE until they've got inflation where they want it to be. But what else would you say?
No, that's it. If the markets are collapsing, yeah, absolutely. They'll stop QT. They'll go back to QE. They'll start cutting rates. At the end of the day, they're going to protect the financial markets first and foremost because of the knockoff effect that it has on the overall economy. Inflation is definitely coming down now. So CPI will come in tomorrow, probably barely above 3%. And, it's on a trajectory well back to 2% now. That's going to continue to kind of work its way through as housing prices, which are coming down, start to get filtered into the CPI index. That's going to keep a lower pressure on CPI. So now the Fed's got room at this point to both cut rates and to do QE, but there's no reason to do that until you either get a recession or some type of market-related event. Now, as far as the lag effect goes, that's, the market is aware of the lag effect. Again, we're all kind of expecting this lag effect to show up one night. We're going to wake up one morning and the whole floor is going to drop out of the markets and the economy and everything else. And that's not going to happen. There are risks out there. The student loan repayment issue we've talked about before. That's going to those student loan repayments are going to start in August, September. Theoretically, that's over $300 a person. So that's about $15 billion a month in retail sales that will go away literally overnight if that would occur. But, the administration is trying to figure out a way to circumvent the Supreme Court decision on that. And we'll see what they do. But, there are certainly risks. There's not. But the lag effect is going to show up. It is going to slow economic growth. It is going to cause issues. But unless there is a credit-related event, the bottom is not going to fall out of the market.
Okay, and you just went to where I was going to go, which was the student loan repayment. What type of implications you think are likely from that? Lance, you kind of gave your statement there. Let me just ask you, let's say the administration's current Plan B is not allowed to go through, right? How big of a deal do you think this?
That's a big deal. Yeah, that's a big deal. I actually wrote an article on this. It's on our website, realinvestmentadvice.com. I think it was last Friday, talking about student loan repayments. But it's roughly $12 to $15 billion a month in potential retail sales, because that's where the money goes, right? So if I don't have to make a student loan payment, what am I doing with money? I'm spending that money elsewhere in the economy, services primarily, going out to eat, doing whatever, paying on credit cards, and that's been that's been one of the reasons, to Jonathan's point, why the economy's been a lot more resilient than people have expected. You had $1.7 trillion from the federal government come in terms of this infrastructure spending package that's been helping industrial companies as municipalities around the country have started gearing up for projects. And then the fact there's been a moratorium on student loan payments. And remember, a lot of those extra benefits that people were getting from stimulus, in 2021 and 2022, like extra child tax credits, those type of things, those didn't end until just this past December. So to Jonathan's point, there's been a tremendous amount of money in the economy, still is, from all the COVID programs. And that's been one thing that's kept the economy from lagging as much as people thought, and why the recession hasn't shown up yet. But this cut of spending, if student loan payments restart, could be and this is the point of the article, that could be the thing that actually triggers the economy, because it's big enough to hit retail sales, which is 40% of PCE, which is 70% of GDP. So if you want to trigger, that's potentially it.
All right. And I imagine that, monetary policy takes a lot longer to impact the economy, because it sort of has to filter its way into the real economy, whereas fiscal stimulus, much more stimulative, immediately stimulative, because you're pumping it directly into the economy. This is basically reverse fiscal stimulus, right? You're removing it directly from the economy here, right?
Yeah.
Okay. Jonathan, New Harbor guys, anything else you want to say about student loans? All right. If no one's dying to, don't worry about it. Okay. So another question here has been around interest rates. Both where do you guys see interest rates going, but also really the whole TINA versus TARA scenario, right? Where all of a sudden you can get a really pretty nice, super safe return in bonds, government bonds at least. And is that going to influence capital flows from here in any material way? Let's see, Jonathan, why don't we start with you on that one?
Well, I can speak from our experience and from talking to other advisors, and I haven't looked at the large flows, and Lance might have a bit more there. But no, I think it already has had some effect on flows, that we have more and more clients, and as I say, talking to other advisors who are saying, look, if I can clip 5% with very little volatility, no volatility, and a guaranteed return, then I want to have more of my money going after that kind of return, a guaranteed return. So we definitely have seen more flows into shorter term bond market. Our view, again, is the Fed and the Bank of Canada, the major central banks around the world, are probably, they've already telegraphed this, another 1 or 2 increases. And I do think they'll probably try to hold them up there for an extended, for a relatively extended period until there's a problem. Then that means that I think there's also an opportunity to start to go out a little bit in duration. Again, we're not big bond traders, we're not bond kings, and we're not trying to anticipate all the yield curve moves. But I do think that as we start to get close to the end of this, it just makes perfect sense for people who can hold bonds 3-5 years or more to start looking out the time corridor, and then hopefully getting a bit of a capital gain if rates do come off, looking out another year or 2 from here.
Okay, great. And Mike, why don't we go to you? How is this new environment of attractive bond yields impacting how you think the markets might behave from here, but also how you guys are positioning?
Yeah, as others have said here, there is an alternative, and we're still close to 40%, 35% or so in short-term treasury bills, because they're yielding 5.1, 5.2% on the 6-month T-bill. I don't think they're going to stay there. It's tough, a murky picture like everything in the market right now, because the 10-year just broke 4%. I think it might be just back below it. I didn't look at it today or yesterday, and long-term bonds have been very weak. TLT continues to be weaker than we expect. It broke through 100. It's trading right about 99 and change right now. So yields have gone up a little more than we thought they would, and so short term they're technically bullish, and we have to respect that to some extent. And to do that, to respect that break, we have hedged our TLT position. with an options collar, which basically means if yields continue to go up and long-term bonds fall, then we have at least a line in the sand or a floor to protect that position. Still think that long-term yields are going to go down a lot. Maybe even the 10-year could go down to 2% again. But I think that happens when we see a big drop in the market, maybe even a collapse in the market and or an economic crisis. Then I think the Federal Reserve and other central banks revert to full-on quantitative easing and, adding tens of trillions more to their balance sheet. I think that's likely to happen eventually. The valuations that we're seeing are not sustainable. Shiller PEs are sky high, margin adjusted PEs are sky high. Just about any reliable measure of valuation is sky high, at or above levels we've seen at other bubble peaks like 1929 and 1999. The problem is valuations can stay that way for a long time. And honestly, valuations have been relatively permanently elevated for all of this century, for the last 20 years, with a couple excursions to try to correct. So who knows how long that can go on? Maybe it can go on longer. But in terms of yields, short term, we're hedging long bond positions. However, we still think it makes sense to nibble on long bond positions if you don't have any. 10 to 15% can make sense in either an ETF that buys long-term bonds, or you can even buy the 10-year treasury bond directly. I think it would be a good thing to do here for 10 or 15%. The 2-year looks increasingly attractive here. We're considering adding a piece there if individuals only own short-term stuff, maybe add another 10% of the 2-year and keep most of the rest of the bulkier stuff or your cash at around the 6-month mark, 6 to 12-month mark. So, maybe 60, 70% short-term, another 10% 2-year, another maybe 15% 10-year plus. That's what we think makes sense right now. And ultimately, we think long bond yields are going a lot lower. Just have no idea about the timing.
Adam, I'd like to just quickly add on to that. So if you look at, not only have nominal interest rates risen, but real interest rates have risen, obviously, with the cooling off of some of the inflation extremes. You look, for example, right now, the 5-year real nominal yield on treasuries is like 2%. And actually, look over the last year, typically when that rises, stocks will drop. And what we've seen over the last several months here is since April is real rates have risen at the same time the stock market has risen, mostly in the form of multiple expansion in the stock market. And again, very narrowly driven stock market. So we're starting to see a breakage of a pretty tight correlation there. We think the stock market's gotten, broadly speaking, way ahead of itself relative to where real rates have gotten.
All right, great, very well said. All right, I got a couple of curveballs here, and let's just dive into them. I'll let anybody take them, but I'm going to pitch the first one to you, Lance, because I saw you yawning there, and so you're going to get punished for that. All right, here's a fun one. Is AI going to replace financial advisors?
Probably, to a large degree at some point. Look, we're in a market where it's more and more where people are just trading stocks now. I mean, you have Robinhood, you've got robo-advisors, you've got all this. And, it's all about cost and efficiency. And if AI can do a better job picking stocks to chase markets, then yeah, there's going to be I'm not going to say all financial advisors. There will be a cutout of financial advisors that will manage larger amounts of wealth. But for the younger generation, they're going to grow up with this stuff. Yeah, probably there's going to be a lot of financial advisors to get replaced by this.
So you'd have a robo-advisor who is literally a robot or an AI.
Yeah, pretty much. And there's an advantage to it. It takes all the emotion out of it, right? So the advisor will just tell you what to buy or sell.
What's interesting about that, and I'll let anybody else chime in on this, but is, you sort of think about investing as trying to find an advantage, right? Because you're trying to beat an index. But if everybody is using the same formula, how can you have an advantage, right? I mean, wouldn't it just, at that point, you're just buy the index?
Well, look, this is the whole passive investing robot, right? It's already the passive investing problem is already affecting the markets. This is why you have 7 stocks driving the market this year. This is why the markets didn't fall as much as last year as everybody thought it would, because the big stocks were holding up the market. And it's all because of these passive flows. The trick with AI and what will be important, and this will be the job, this is why I'm encouraging my children to go to college to get mathematics degrees, is it'll be who can program it better, and who can program it to find those opportunities in the markets as these things are occurring, to find those differentials, because you can do that. It's all about programming, and it's how well you can program it versus everybody else. So there will be certain programs that work great, certain programs that won't, just like financial advisors.
Well, I was going to say, so that, I mean, that's kind of like what we have today with quants, right? With building a model, right? It's just who's going to have the best AI-driven solution
Right.
here. But even to your point, I mean, even if, you know, folks below a certain asset level, everybody's getting the same black Model T version of the AI trading thing. I mean, for a lot of people, that's probably all they really need early on, right? Because it's more of sort of the forced savings and putting their money to work for them. And then once they get above a certain threshold where the advisors can start doing more interesting things with the money, you know, maybe they graduate from the AI only solution there. Any other guys who want to touch this before we move on to the next curveball?
I would just say that, I agree with, Lance's basic comments that there's no question in my view that the role of the advisor is going to continue to change and become less important for quite a few of the clients out there. And we've already seen that. And I know in Canada, if you go to the banks control much of the financial advisory distribution up here, the banks and life insurance companies, and they've already automated everything and turned every one of their clients into a number already. And so you really don't need to be seeing a person to get the kind of investment advice that you're typically getting from the banks and life insurance companies up here, as I say, who control the vast majority of the distribution. So if you can add an AI component, then I think it'll make the work of financial advisors even more redundant, I guess. And so for us as active investors, I think we're looking at it as an opportunity to differentiate even more. And as you say, stay away from these algorithms and actually, take a longer term view, use time arbitrage in terms of the businesses and personal service. And so you're going to spend time with clients, you're going to, educate them in terms of investing, and people still, in our view, want the personal interaction, and they don't want to be treated as an institutional number. And that's critical to our business.
Yeah, that's a valid point. I mean, it's going to be the personal relationship, the financial planning, those type of things, outside of just the stock picking and the investment management that separates financial advisors from AI.
Right. I mean, at the end of the day, people go to a financial advisor because they want help with their life goals and needs and whatnot. And you don't want to be shoved into a one size fits all, be a number to them. You actually want to.
That's what they say until the market goes up with 7 stocks, and then wonder why they're not in 7 stocks.
Yeah. And that's the emotional part, right?
Yeah.
All right. Here's the next one, and I will direct this to you guys at New Harbor, but anybody can chime into it. This is the most family-friendly version of the question that this guy asked. Anyone talking? How come no one's talking about one of the best performing assets of this year, Bitcoin? His related questions had to do with, hey, gold gets a ton of love, and yet it's not really done that much this year. And Bitcoin, is basically doubled, and nobody's talking about it, at least on this channel. So, New Harbor guys, how do you want to tackle this one?
What can I say?
Mike? Yeah. Why don't you kick us off there, Mike?
Sure. It's, Bitcoin, it's a difficult topic to completely understand, to be honest. It's true. The chart has looked pretty good this year. It's nearly doubled from its bottom. Look, we love the idea that it's an alternative currency, that it's outside the control of central banking. I know that Bitcoin proponents believe the same thing. I'd love to believe that it's the nirvana, that it's the solution. We've chosen, frankly, the answer is that we've chosen at New Harbor to focus on gold. And it's just something that we trust more, that, that the market has been around for thousands of years. The charts look beautiful. I could share a monthly chart of gold, and maybe I can do it here quickly while I'm talking. But the monthly chart of gold over the last 20 something years, looks wonderful. And I could do the same thing for Bitcoin. It's just that, Bitcoin is difficult to spend directly. And I guess you could say the same about gold. Gold is difficult to spend directly. And maybe both currencies would be easier to spend directly if we entered some kind of crisis period. You still have to rely on other exchanges. For gold, you've got to sell to a broker. For Bitcoin, I know you can trade it directly, but it's not really that widespread. You still have to sell through an exchange and convert to dollars. That's the real problem, is that you have to convert to dollars. And I just think that gold's a better option. I think I'll probably, in the sake of time, not share that chart here. But I don't really have much else to say. I know there's a lot of reasons to own Bitcoin. We've studied it extensively. We haven't placed position other than a very small position that we have in a diversified commodities fund that holds about 1% Bitcoin. We've got a very negligible exposure.
If I could just quickly add on to that, when we talk about gold, we think about it in two ways. One is a kind of an insurance policy, and that typically we're referring to physical precious metals and things like that, monetary, insurance, if you will. But we also talk about it as investment, and we've talked plenty about from a big picture standpoint. We think the precious metal mining stocks are a very good buy here, even though they've struggled recently. They're very low valuations relative to historical. Their balance sheets have cleaned up quite a bit. From an insurance standpoint, we're pretty practical. Governments are pretty obviously honed in on Bitcoin and the threat that has to fiat currencies, and there's plenty of movement going on with central bank digital currencies. Quite simply, we think governments are going to try to really clamp down either through outlawing or taxing or controlling of the internet or energy systems that support digital currencies. We think that's going to be under the crosshairs, frankly, as an insurance policy. So we prefer kind of good old-fashioned precious metals for that role.
Okay, I got a follow-up question on good old-fashioned precious metals. Just Jonathan, Lance, anything else you guys want to say on Bitcoin, or should we move on?
Go ahead.
Okay.
Yeah.
All right. So, and Bitcoin folks, it has been a while since we've had a discussion on the channel. I think the last one was with Dan Tapiero about 2 months ago about Bitcoin and cryptos. I will commit to bringing on another Bitcoin expert, crypto expert on the channel relatively soon, just so we keep that discussion alive here. We are not intentionally ignoring it. I will say it's not a topic that I get asked a ton about by the Wealthion audience. From previous surveys and whatnot, we don't have a ton of crypto owners on the channel, but it's not a topic we should be ignoring. Totally agree with that. All right, I was trying to, there were questions about this. There's just so many been asked now, I'm having trouble finding it. But there've just been news articles coming out in the past couple of days about a new Brics trade currency that is apparently going to be announced at the upcoming Brics meeting in August. And it's going to be backed by gold, presumably. So curious just to hear any general thoughts you folks might have on that, but specifically, and maybe New Harper, I'll go back to you guys first, and then we'll go to you, Jonathan, because you guys, I know, have gold fairly prominently, or gold miners prominent in your portfolios. Do you expect to see any response to gold from that? And I guess presumably we should have, because the news is now out. But anyways,
I'll just chime in quick there. I think this is one step in a bigger trend. I wouldn't want to make overly an oversplash about that news. India, for example, I think very quickly came out and said that they're not anytime soon going to jump into that boat. But it does speak of a bigger picture, kind of riot, if you will, against the U.S. dollar as a reserve currency. And these are huge tectonic shifts that take time to play out. It's something that will play out over years, I think, not over months. So I wouldn't make over hype about that news coming out of the Brics meeting.
Okay. Jonathan, any comments on that? And then also, whether you do or you don't, just give us your current assessment of the precious metals mining sector. Because I know that that's something that you're fairly invested in. We've talked about on this channel, and I know that a number of our viewers follow that space relatively closely.
Right. Yeah. I mean, I agree with John's comments in terms of the Brics currency and collateralizing that with gold. I think we're dead on that. This is just one of a number of steps that are being taken as the world tries to, at least many countries try to extricate themselves from the dominance of the U.S. dollar. But that is much easier said than done. And the only reason they'd want to back it by gold, as we know, is that most of those currencies whether it's Brazil or India or the Chinese. You would not want to own those currencies. You know, even less trust in those governments than we would have in our own North American governments. And so, of course, you're going to want to back it by gold, because otherwise it would never even work. But I think it's a trend to watch. And so we look at it as a trend to watch. It's just, you know, geopolitical events taking place in the world. The U.S. clearly has stepped on a lot of toes, has politicized the SWIFT system and used that to, you know, sort of hammer different countries and people. And so there's no question that other countries will want to try to, as best as possible, get around the US dollar. But that, in our view, is very difficult. And so we're not going to build gold positions around that. It is interesting. I think it's just another factor that plays into, the long-term strength of gold and the precious metals. In terms of the gold and precious metals, I mean, I think silver in particular is very inexpensive. It always seems to be. We continue to just pick away very carefully on some companies that have exposure to silver. Gold, I also think, given the money supply and the monetary policies and the incredible deficits and debts that we've accumulated, is also relatively inexpensive. In particular, and we don't own a lot of the miners, as we've talked about before. We have a lot of the royalty companies. So the Franco-Nevada would be the more expensive one and the larger player, but the Wheaton Precious Metals, the Royal Gold, the Sandstorm, the Osisko, who just had a change in CEO there, is relatively cheap. But definitely the miners have just done terribly over the last little while. And so companies like Agnico Eagle, for example, which is a very well-run gold company, is very inexpensive. And I'd suggest that if you were into the miners and wanted to take positions, this wouldn't be a bad time, just a dollar cost average, and to pick away at them. They are very, very inexpensive when you look at them on a basis of, free cash flow, and costs are coming down. Energy costs have come way off. And they're running their facilities much more efficiently. So I think there is some opportunities there, and there's some good bargains.
I'm just curious, given that list of positive elements you just talked about, why do you think they're sort of slumping right now?
That's a good question. I wish I had the answer. I mean, I think interest rates are going up. The U.S. dollar has been pretty resilient. And it's come off a little bit versus the last year, but not much against the global currency. So as long as the U.S. dollar is strong and interest rates are tending to go up, I think that just keeps a bit of a damper on the gold price. So we're expecting that as interest rates peak, and if there is weakness in the U.S. dollar, then that certainly could put a little bit more air under the gold price.
Okay. In our last couple of minutes here, I just want to bring it to the housing market, as I said I'd get to earlier in the discussion here. Lance, I'll come to you with this. Real quickly, I just want to let folks know I just recorded a great interview with housing analyst Nick Jurley yesterday. Nick, as always, brought a ton of charts. That interview is going to go live later this week. So if you want to do a real in-depth dive into the latest stats on the housing market, just stay tuned for that. Basically, I want to ask your guys' thoughts of where you think the housing market is going to go from here, and then what implications you think that'll have for the economy. Before I do, real quickly, Lance, before I get to you, I just want to put up two quick charts here. So housing prices, in theory, should be a function of what local incomes can afford. In many ways, home prices should be based on what those homes could be rented for. Right. That's why, in the CPI calculations, they use owner equivalent rent. Right. What's interesting, and this stat really caught my attention when I was talking to Nick yesterday, is that 57 of the 100 largest U.S. cities now have negative year-over-year rent growth. So we actually are beginning to see rents come down, and they're coming down in the majority of U.S. cities right now. I know I'm going to get a bunch of folks in the comments saying, well, I'm not seeing it here right now. But apparently the data is beginning to show this. Tied with that as well is a rise in rental vacancy. So you can see here, rental vacancy plummeted, coming out of the pandemic, but it's now been spiking again. And it's back basically now to pre-COVID highs, and the momentum, seems to be continuing upwards. So, when you look at those two data points, sorry, let me hide this here. It's, it raises some cause for concerns. Like I said, Nick's got a ton of other charts. If you want to see those, go watch that video. But let me come to you, Lance, here. Where do you think the housing market's headed?
Well, first of all, you're talking about rental properties. Multifamily is super overbuilt. That was a problem that was created by this, opportunity zone and the tax credits that were given. Everybody went to run out and invest money into building multifamily properties in underdeveloped areas, and that's a whole disaster that's going to wait to happen for those people in the next year or so. Commercial real estate's still a big problem as well. Just because you got 1 billion square feet of unoccupied office space, and that's not coming back anytime soon. So the housing market, though, is still caught in this problem that you've got baby boomers that have 3% mortgages that would like to sell their house, but they can't, because if they go to buy another house, then they're going to wind up having a lot higher interest payments. So you have a supply problem in the housing market, that new homes are coming onto market. They can't come on fast enough because you have a dearth of inventory of existing homes, and that's keeping these prices more elevated. They are correcting, but they're not crashing like everybody thought they were going to, because of the supply problem that was caused by higher mortgage rates and locking people into their houses.
Yeah, on that, Nick was saying that we were comparing and contrasting the new home market versus the existing home market. And essentially, new homes are selling, at a much more aggressive clip. But it's because the builders are doing two things at once. They're discounting the price by around 15%, Nick was saying, and they're doing mortgage drawdowns. So they're essentially offering people like high 4 or low 5% mortgages versus the current mortgage rate, which I think is like 7.3 right now. So what he's basically saying is the new home market is giving us a preview of where the existing home market's going to need to go, right? If you want to move transactions, you're going to have to basically do the equivalent of price declines and or better mortgages, right? Yeah.
And I have a suspicion that if prices can kind of hold up and mortgage rates come down, then you'll have a big inventory. You'll have a big jump of inventory in the existing home space, but it's just going to be a question of how this works out over time.
Yeah. All right. So Jonathan, like I said, you're there in Canada, and just for our U.S. viewers, we're used to having 30-year mostly fixed mortgages. In Canada, you guys have fixed mortgages, but they go variable after 5 years, at which point most people go and get a new mortgage. So in theory, you have about 20% of the country that's re-rating their mortgage every year. Right. So you're on a much more accelerated schedule than we, in terms of the lag effect, people experiencing the lag effect there, because they're going to re-rate from a relatively cheap mortgage to one that's maybe more than twice as much. Correct?
Yeah. So, we have the adjustable, in terms of Canadian markets, people can have an adjustable rate mortgage. And so then they can adjust as the rates change. They can also take out 1, 2, 3, 4, and 5 year mortgages, but typically the longest you can go typically is around 5 years, and then it resets whatever the rate is when that 5 years is up. So you've got a whole group of people that have quite a variety of mortgages coming due. But at the end of the day, there's at least 20%. There's actually more than 20% that'll be coming due every year. So we're starting to see that you don't have to move, and you're going to get a much higher increase. So we're starting to see that impact. Now, what's interesting, again, go back to what Lance was saying about supply. In Canada, we have a real shortage of housing. So not only do you have the prices way too high and interest rates have been way too low, and now they've come up, and so the funding costs are high, we still don't have enough housing. So we did see housing prices drop about 20% or so over the last sort of year over year, but they've largely stabilized over the last couple of months in Canada, believe it or not. And it's quite interesting to see them stabilize despite people just having a real tough time making payments. What we talked about, I think, on the previous Q&A, is that the banks have extended the term of the mortgage. So now you have amortizations going from 25 years up to 35 years. So the banks are working with some of the people, but we've got a massive amount of immigration. So we've got, just in our own province of Ontario, about 15 million people. Last year, 405,000 new immigrants came into Ontario, and there's not enough housing. So it's very difficult to predict. I think it's what it's going to cause is people not spending money in other areas, and just a lot of pressure on our overall economy, because people are going to have to dig to make those mortgage payments. And I think housing prices will be sloppy, and they certainly won't go up much. but the supply demand characteristics are so out of whack in this country. It's unbelievable. And the regulatory regimes here that inhibit housing and building of houses, and the costs that are added on to the housing costs are just outrageous, despite the fact that we've got more land than anyone. Right, we have more land to build on. So I think because of all of that, we're going to see sloppy prices, probably down a little bit, but it's going to hurt our overall economy big time, because people will not be able to spend in other areas, and that's what I think is concerning. The Canadian population, certainly the Canadian government and the Bank of Canada, because the Bank of Canada has been trying to lag the interest rate increases by the Fed, because they know we just got way too much debt in this country, and it's gonna hurt. Yeah.
All right. So it sounds like a contractionary force on economic growth that's being added to the contractionary force of the higher interest rates, that in the U.S. is being added to the potential contractionary force of the student loan repayments going into the process there. Now, of course, we're going to have a slower burn on our housing market than you, because we don't have this massive re-rating every year. But it's still not negligible. All right, guys. Well, fantastic discussion. We're at the end of the hour, so we're going to have to leave it there. Folks who are watching, thanks so much for participating. Thanks so much for asking such good questions. Just a reminder that if you want to talk to any of these advisors, get a free consultation from them. Again, they don't cost anything. There's no commitment to work with these guys. It's a public service they offer to help people position themselves as prudently as possible for the futures that they see ahead. Just go to wealthion.com and fill out the short form there. Just working there to put up my little magic URL there at the bottom of the screen. Guys, thanks so much. I will see you all later on this channel. John and Mike, I'll see you guys later this week. Same with you, Lance. Jonathan, we'll have you back on again soon to do a deep dive into Canada and resource investing. Guys, thanks so much for joining me. Everybody else, thanks so much for watching.
Thank you.
Well, thank you very much.
Thanks, everybody.